Good afternoon, everyone. It's Doc here from OnTheMoneyOptions.com. It's Monday, January 7th, 2019, and we're looking at our weekly technical analysis. I want to start this week with a couple of charts that I use very often that I think will give you some indication of what has happened over the last couple of months. I rely on these charts. They've never failed me. I think they give you a very good indication of what is happening or about to happen in the markets. So the first chart that we're going to look at is the ETF SPY. We're looking at the relative strength indicator at the top. And at the top, you'll see there are a number of red arrows. And each time the relative strength index has dropped below 50 and stayed there, we've seen some significant downside in the S&P 500. So as you can see here, we saw the 50 level break in October, and obviously since then we've seen some significant downside in the indices. So this is a really good indicator to tell you something is happening even before it happens. The next chart that we're going to look at is the SPY again, and the bottom of the chart is important this time. This is the 26-day rate of change. Now I have this chart all the way back to 2007, and as you can see, when the rate of change is below zero, we've seen some significant downside. Obviously 2008, 2009 show you an extreme example of that. But this happened again in 2011, and then again in late 2015, early 2016. So recently, again in October, we saw the rate of change drop below zero as in the shaded lines that you see. And once again, we see the index drop. So let's look at some of our normal technicals. This is the the New York Stock Exchange bullish percent indicator, and today we had a 3-box reversal on it, which means that about 6% of the stocks on the New York Stock Exchange switched from point and figure sell signals to point and figure buy signals, and this is a significant move. We've been as low as 20 and now we're back to 27. So this might suggest that we're at an intermediate bottom, or there's going to be some testing of this bottom area for the foreseeable future. The next chart we're looking at is the New York Stock Exchange Advanced Decline Cumulative line. This is on a daily basis. And as you can see, the Advanced Decline typically runs in channels. And when it comes out of the channel, you can generally expect something bad to happen when it comes out of the channel to the low side. And as you can see here again in late 2018, again about the October time frame, we saw it drop down below the channel, and the follow-through was some relatively significant downside in the market. Now you see over here in the Zoom thumbnail that it's bounced off and started back up, so maybe this again is another indication of intermediate bottom. This chart that we're looking at is the relative strength of the S&P 500 relative to the SPX. This is sort of our risk on, risk off. And as you can see, this goes back to October of 2010, or actually before that. And we touched 53 in October 2010. We touched it again in October 2016. And we touched it this past November. Again, it looks like it's bounced and moving back off the top. So maybe this again suggests that we've had an intermediate bottom. Our next chart is looking at the equal weight index, the SPX-EW, relative to the S&P 500. This gives you a better view of how all the stocks in the S&P 500 are doing, as opposed to the top 20 or 25 stocks, which take up nearly half of the weight of the S&P. So what you're seeing here is that recently we've bounced off a low and we've moved back up. This suggests a little broader participation in the market. And once again, this might suggest that we've got an intermediate bottom in, and we're going to test this area for a little while. Our next chart is the VIX, and I want to point out something here. I have the VIX with a Keltner channel on it. The Keltner channel is a 2 average true range band around it, which really is measuring the volatility of the VIX. And what you see here is that every time it gets out of the top, as signified by the red arrows, this oftentimes signals an intermediate bottom in the market. And once again, just the other day, we had a top that popped out to the 36 level and then came back inside the bands, and that signified an intermediate bottom in the market. This chart is and you wonder what's this got to do with anything. This is the TLT as it correlates to the S&P 500. Now, when the market gets out of whack, a lot of things get out of sync. Over a long period of time, you want to see the bond market, particularly the long bond market, positively correlated with the S&P 500, which is what you see here, except in times when you got some really big downtime. So what we have at this point in time is we've come down to the no correlation, and we've turned and we're moving back up. So maybe things are getting back in sync a little bit. This last chart that I want to show you is the S&P equal weight consumer staples relative to the equal weight consumer discretionary. Now, typically when you see a really scary time in the market, everybody heads to the staples. You see that signified by the red lines that are going just about straight up. In long-term uptrends in the market, you see that consumer discretionary typically outperforms staples. So again, if you look to the far right-hand side of this chart, you'll see that we're in one of those little areas where we've got a red line going nearly straight up. So this might indicate that we've got a bottom in. So until next time, this is Doc saying so long and stay hedged.